the Supreme Court ruled and silver collapsed, 79.80. In a single session, everyone called it over. But then, something happened that no headline reported, no anchor explained, and no algorithm predicted. Silver didn't just recover, it was bought back, ferociously, all the way to $84 within the same session. The question is not what moved. The question is who moved it and why they needed you distracted while they did it. Welcome to Financial Crisis Explained, the one place where the market doesn't talk to you like you're a child. Now, before we go any further, if you're watching this channel for the first time, think of subscribing, like taking your daily morning newspaper. You know that feeling. You wake up early, cup of tea in hand, and that newspaper is already waiting at your door. You don't question whether it'll come. It just does. That's what subscribing does here. Every time we publish, it lands right at your door. No searching, no missing, no confusion. Just press that button once and consider it delivered. And one more thing before we begin. Drop a comment below right now. Tell us, where in the world are you watching this from? Because this story we're about to tell you, it does not belong to one city, or one country, or one currency. It belongs to everyone who is paying attention. Now, let's get into it. It was supposed to be a quiet Friday. Markets were steady, positions were held, and most traders were watching the clock, waiting for the weekly close without incident. Then the Supreme Court of the United States spoke, and nothing stayed quiet after that. The ruling came fast. The headlines came faster. Trump's emergency tariffs struck down. Illegal, the court said, unconstitutional in scope, a sweeping decision that landed not just in courtrooms, but directly on trading floors, commodity desks, and every screen that tracks the movement of real money in real time. Within minutes, silver broke, not drifted, not softened, it broke. From a position of relative stability, silver was sold, hard, fast, and without hesitation, down to $79.80. The financial media did exactly what financial media always does in moments like this. It explained the obvious. Tariff ruling creates uncertainty. Commodities under pressure. Silver retreats on legal news. Clean, simple, digestible, and almost entirely misleading. Because here is what they did not explain. A Supreme Court ruling on tariffs does not, by itself, change the amount of silver sitting in a vault. It does not alter the mining output from Peru or Mexico. It does not suddenly create new supply that the market was previously missing. It does not touch the physical reality of the metal one single degree. What it changes is sentiment. And sentiment in the short term is the most dangerous force in any market. Not because it reflects reality, but because it temporarily replaces reality. For a window of time, sometimes minutes, sometimes hours, the market stops pricing what is true and starts pricing what people feel is true. That window opened on Friday. And someone walked through it. To understand what happened next, you have to understand who was in that market at $79.80. Retail traders were selling. That is almost always the case when a headline hits with that kind of force. The instinct is to exit, to reduce exposure, to wait for clarity. And clarity, in the age of algorithm-driven news cycles, feels like it never comes fast enough. So retail sold. Institutional desks paused. They ran their models. They read the ruling more carefully than any anchor did. They looked at what the decision actually meant for trade flows, for dollar strength, for the broader commodity complex. And what they found did not match the price they were seeing on their screens. Because $79.80 silver in an environment of confirmed physical deficit, confirmed vault drainage at ComX, and a global demand picture that UBS had just quantified in a report most people would not read until Monday, was not a dangerous price. It was an opportunity. But let us stay with the ruling itself for a moment, because this is where most analysis stops too early. The Supreme Court did not simply rule on tariffs, it ruled on the scope of executive power in matters of emergency economic policy. That distinction matters enormously for anyone trying to understand where capital flows in the months ahead. When the boundary of executive authority is redrawn by the highest court in the nation, it does not only affect the policy in question, it sends a signal across every trading desk that has been pricing in future policy certainty. It raises a fundamental question that markets hate above all others. If this was overturned, what else can be? That uncertainty does not resolve in a session. It does not resolve in a week. It embeds itself into positioning decisions, into hedging strategies, into the quiet conversations happening in offices that do not issue press releases. And commodities, real, physical, finite commodities, have historically been the first place serious capital moves when policy certainty begins to erode. Silver at $79.80 was not a market in panic. It was a market being reset. And within the same session, The reset was confirmed because what came next was not a slow recovery, it was ferocious. Most people watched silver fall to $79.80 and thought the story was over. They were wrong. They were not just wrong about the direction, they were wrong about what they were even watching. Because what looked like a collapsing market on every retail screen, every financial ticker, every breathless news scroll, was not a collapse at all. It was a clearing event. And the moment the weak hands finished selling, the moment the last panic order was filled, the moment the algorithms had squeezed every retail stop they were going to squeeze, something shifted. Not gradually, not cautiously, ferociously. Silver moved from $79.80 back to $84 within the same trading session. Stop and sit with that number for a moment. That is not a bounce. That is not a technical correction. That is not the market stabilizing after volatility. A forward 20 recovery in a single session in a commodity market against a backdrop of a Supreme Court ruling that had just rattled the entire tariff framework of the world's largest economy. That is deliberate. Markets do not move like that by accident. Prices do not recover with that kind of velocity unless something or someone wants them to recover with that kind of velocity. The question that every serious analyst, every strategic thinker, every entrepreneur who understands that markets are not random must ask is the only question that matters here. Who was buying at $79.80? Because buying at $79.80 on that day required something that most market participants do not possess in moments of peak uncertainty. It required conviction, not optimism, not hope, not a gut feeling that silver would recover. Conviction. The kind that is built on data, on positioning intelligence, on an understanding of physical supply dynamics that goes several layers deeper than what appears on any public screen. To buy ferociously into a market that is falling on Supreme Court headlines, while retail is selling and media is explaining the damage. You cannot be reacting to the news. You have to have already processed the news. And the entities that process news at that speed, at that depth, and with that kind of capital ready to deploy, are not retail traders sitting at home watching tickers. They are institutions. They are sovereign adjacent funds. They are the desks that read the UBS deficit report before most people knew it existed. And they were waiting. Now consider what was happening beneath the surface while this buyback was executing. The ComX vault drain had not paused for the ruling. It had not paused for the headlines. It had not paused for the uncertainty. Physical silver was leaving registered vaults at a pace that had been quietly accelerating for weeks. Not dramatically, not in a way that generated its own headlines, but consistently, methodically, in the way that real structural shifts always move before the wider market notices them. When physical metal leaves a vault at that rate, it does not return easily. It goes into industrial supply chains, it goes into sovereign reserves, it goes into private hands that have no intention of selling it back into a paper market at any near-term price. That metal is gone from the tradable float. And when the tradable float shrinks while demand remains constant or grows, the mathematics of price become very simple, very quickly. Then there's the UBS number. UBS quantified the silver deficit. They put a figure on the gap between global silver supply and global silver demand. And the figure they produced was not a warning for next year or the year after. It was a warning for now. But here's the part that most people will process incorrectly, exactly as they always do with deficit data. A deficit does not mean the price rises tomorrow. A deficit means the system is consuming more than it is producing. And systems that consume more than they produce do not stay balanced forever. They reach a point, sometimes suddenly, sometimes after a long, slow grind, where the imbalance can no longer be managed quietly. That point has a name in commodity markets. It is called a squeeze. And gold, sitting quietly at $5,100 at the weekly close, was not celebrating anything. It was confirming everything. Gold does not close a week at $5,100 in an environment where the smart money believes the commodity story is over. Gold closes at $5,100 when the smart money believes the commodity story is only beginning. Silver's wild turnaround from $79 to $84 was not the headline. It was the signal, and the signal was pointing at something much larger, much more structural, and much closer than most people are prepared for. There is a war being fought in the silver market. It does not make the front page. It does not trend on social media. It does not get discussed in the evening financial roundups where men in suits debate whether the Federal Reserve will move rates by 25 basis points or 50. It is quieter than all of that. And it is far more dangerous than all of that. It is the war between paper and physical, and for the first time in a very long time, physical is winning. To understand what this means, not emotionally, not as a slogan, but structurally, you have to understand what the silver market actually is. Most people who follow silver prices believe they are watching the price of silver. They are not. They are watching the price of a contract. A paper contract. A legal agreement between two parties that says a certain amount of silver will be delivered at a certain price at a certain date. Most of these contracts never result in delivery. They are rolled, closed, offset, and replaced in a continuous cycle that allows an enormous volume of silver to be bought and sold every single day, without a single ounce of physical metal ever changing hands. This is not fraud. This is not conspiracy. This is simply how modern commodity markets function. The paper layer exists to provide liquidity, to allow hedging, to let producers and consumers manage price risk without constantly moving physical metal across the world. But the paper layer has a vulnerability, a structural, mathematical, unavoidable vulnerability. The paper market can create contracts faster than mines can create silver. Read that again. The paper market can create contracts, obligations, positions, exposure, at a speed and volume that has absolutely no relationship to how much physical silver actually exists in deliverable form. For years, this imbalance was manageable. The paper price and the physical price moved together closely enough that the gap between them was a footnote. A premium here, a slight spread there. Nothing that suggested the two markets were operating on fundamentally different realities. That is changing. And the ComX vault data is where you see it most clearly. When physical silver leaves a ComX registered vault, it is removed from the pool of metal that can be used to settle paper contracts. It becomes unavailable for delivery. It exits the system that the paper market depends on to maintain its credibility. And it has been leaving, week after week, quietly, consistently. The drain that continued without pause through the SCOTUS ruling, through the $79 drop, through the $84 recovery, was not reacting to any of those events. It was indifferent to them. Because the entities pulling physical silver out of those vaults are not trading the headlines. They are not watching the Supreme Court ruling and making decisions based on what an anchor says about tariff policy. They are executing a strategy that was decided long before this week's news cycle began. And that strategy is based on a single, unambiguous conclusion. The paper price of silver does not reflect the physical reality of silver. This is where history becomes the most important teacher in the room. There have been moments before, not many but enough to study, when the paper price and the physical price of a commodity diverged beyond what the system could silently absorb. In each case, the sequence was remarkably similar. First, the physical supply tightened while paper volume remained high. Then premiums on physical metal began rising above the paper price. Then delivery requests increased sharply. Then the entities who had sold paper contracts they could not back with physical metal faced a choice: settle in cash or scramble for metal at any price available. That scramble has a name. It is the same name used at the end of part 2, a squeeze. But unlike a typical short squeeze in an equity market, which can resolve in days, a physical commodity squeeze does not resolve until real metal moves into real hands at a price that clears the market. And in a deficit environment, that price is not $79, it is not $84. Now consider what this means for the business community specifically. Not for traders, not for speculators, for decision makers, for the entrepreneur who holds working capital in currency that is being quietly debased, for the business owner who prices contracts 6 months forward in a commodity environment that is structurally mispriced, for the young professional who is building wealth in an era where the rules of financial stability are being rewritten by forces that do not announce themselves. The physical versus paper fault line in silver is not an abstract market phenomenon. It is a signal that the pricing mechanism the entire financial system relies on to allocate capital correctly is under stress. And when pricing mechanisms fail, even temporarily, even partially, the consequences do not stay contained to commodity markets. They spread. They always spread. Silver's move from $79 to $84 in a single session was not a trade. It was a demonstration. A demonstration that physical demand at the right moment can overwhelm paper supply with a ferocity that no algorithm anticipated and no headline explained. The fault line is visible now, for those who know how to read it. Everything covered in the previous 3 parts was not history. It was context. And context without application is simply an interesting story. This channel does not tell interesting stories. It delivers strategic warnings. So here is the warning. Delivered clearly, delivered precisely, delivered without the softening language that financial media uses when it wants to inform you just enough, but not enough to make you actually move. The SCOTUS ruling on Trump's emergency tariffs was not the event. It was the trigger. There's a critical difference between the two that most analysts will never explain to you, because explaining it requires admitting something uncomfortable about how modern markets actually function. Events are what happen. Triggers are what reveal what was already true beneath the surface. Silver did not drop to $79.80 because a court ruling changed the fundamental supply and demand picture of the metal. It dropped because the ruling created a moment of maximum uncertainty. And maximum uncertainty is the environment in which hidden positioning becomes visible. When silver dropped, the hidden positioning was revealed. And what was revealed was not fear. It was accumulation. Now apply this to the next 90 days. The Supreme Court's decision does not exist in isolation. It lands inside a macro environment that was already under significant structural pressure before a single justice cast a single vote. Dollar credibility is being actively debated at the institutional level in ways that have not been seen in decades. Not loudly, not in press conferences, but in the quiet repositioning of sovereign wealth funds and the gold purchases of central banks that have been running consistently for 2 consecutive years, and in the physical silver drain from ComX vaults that did not pause for a single week of geopolitical noise. When the boundary of executive economic power is redrawn by the highest court in the nation, every forward contract, every trade policy assumption, every currency hedge that was built on the expectation of tariff-driven dollar strength has to be reconsidered. That reconsideration does not happen in a day. It happens over weeks and months. And while it is happening, commodities with finite physical supply and confirmed structural deficits do not sit quietly at $84. They move. Here is what serious capital is doing right now. Not what they are saying, not what their public statements suggest, not what their quarterly letters to investors will claim 3 months from now when the move has already happened. What they are doing. They are reducing exposure to assets whose value depends entirely on policy continuity that the Supreme Court just demonstrated can be interrupted without warning. They are increasing exposure to assets whose value is anchored in physical reality, in the ground, in the vault, in the supply chain, rather than in the assumption that a particular political or legal framework will remain intact. They are not making this move dramatically. They are not announcing it. They are doing what serious capital always does in moments of structural transition. They are moving quietly. And silver's ferocious recovery from $79 to $84 within a single session, against a backdrop of maximum negative sentiment, is the most visible evidence that this quiet movement is already underway. For the entrepreneur, for the business owner, for the young professional building a financial foundation in this environment. The lesson of this week is not that silver is going to a particular price target. Price targets are for people who need certainty to act. Strategic decision makers do not need certainty. They need probability maps. And the probability map this week is painting something very specific. Physical assets with confirmed supply deficits in an environment of eroding policy certainty in a macro landscape where the world's largest economy just had its executive trade authority legally challenged at the highest level, are not going to remain mispriced forever. The paper market can suppress the price of silver for longer than any individual trade can remain solvent, but it cannot suppress it longer than the physical supply can sustain the deficit. And the physical supply is running out of time. Gold at $500 is not a ceiling. It is a floor for what comes next in the broader commodity complex. UBS did not publish their deficit number to generate clicks. They published it because the mathematics of silver supply and demand have reached a point where institutional silence is no longer professionally defensible. When UBS speaks on a deficit, the deficit is no longer early stage. It is late stage. So what does a serious decision maker do with this information? Not tomorrow, not after the next headline, not after the next court ruling, or the next Fed statement, or the next geopolitical event that sends retail traders scrambling for explanations. They will find 3 days too late. Right now. The answer is not complicated. It never is when you strip away the noise. Understand the difference between paper exposure and physical reality in every asset class you hold. Recognize that pricing mechanisms under stress do not send polite warnings before they break. And accept that the most expensive position any serious capital holder can occupy in a structural transition is the position of waiting for confirmation, because by the time the confirmation arrives, the move will already be history. Silver told you who was in control this week. The Supreme Court ruled. Silver dropped to $79 and was bought back to $84 within the same session, ferociously, deliberately, and without a single mainstream headline explaining why. Now you know why. The question is no longer what happened. The question is what you do before it happens again.